Today, we are discussing how far should you niche down and how to go about finding your minimum viable market, an incredibly important concept if you want your marketing to be both effective and efficient. Welcome to the B2B Playbook. We built this channel for small B2B marketing teams who want to drive more revenue for their business. Every week, we're showing you how to create more demand for your brand step by step using our 5Bs framework. So if you're time poor, resource strapped, but you still want to make a big impact on your business, make sure you hit that like and subscribe button down below so you don't miss an episode. Welcome back to the B2B Playbook. Today, we are discussing how far should you niche down and how to go about finding your minimum viable market, an incredibly important concept if you want your marketing to be both effective and efficient. We are into season 7 of the show. We spent seasons 1 to 5 giving away our 5Bs framework for demand generation, releasing it step by step. Season 6, we answered a lot of FAQs on building and implementing demand generation engines. And now we're going to continue to build on that by looking at how demand generation fits into your wider go-to-market strategy. Kevin, for any listeners or viewers that are new to us or want a refresher, could you please tell them what our 5Bs framework is all about?
Of course, George. The 5Bs framework starts with be ready, deeply understanding your dream customers, be helpful, how to develop relationships of trust with them, particularly online with helpful content, be seen, how to amplify that content, and to focus in on those dream customers even more. Be better, how to optimize the whole B2B marketing process that you've built up until that point. And finally, be the best. What are those advanced strategies and tactics that the guys at the bigger end of town are using, how they apply to your business, and how you can build a flywheel from this 5Bs framework.
Very good. Thank you, Kevin. And as I mentioned earlier at the top of this episode, we're talking today about how far should you niche down and how to go about finding your minimum viable market. The theory, it's all well and good, but practically, when do you know that you're targeting the right level of niche, a segment of the market that's big enough to meet your business goals? Kevin, why is this conversation so important?
Well, from my own experience, we had a little bit of time to figure this out, but often businesses have less time to figure that out. And it's certainly something that made a big change in our trajectory once we defined it properly, once we found that right point to really go after. I think we started a little too broad, like most marketers and founders that we've spoken to, that we've worked with, that we've seen also do. They tend to start a little bit too broad. And once they niche down to the right level, they can then accelerate their growth a lot quicker. They're able to communicate with that group a lot better, and they're able to grow their business at the end of the day a lot better in practice. And I think that really stems from this general fear that we're excluding people and therefore losing opportunities that are on the table. But by trying to speak to everyone in your total addressable market or your TAM, you actually end up resonating with no one at all or no one properly. So then without that resonation or proper resonance with a particular group of people that you serve the best, your demand generation or your B2B marketing process or whatever your go-to-market process looks like basically ends up not really working very well or at all, because you're not able to have that connection with a particular group that's really relevant to your particular business or offering. So unless you're speaking to your dream customers and the specific pain points at the end of the day, you're not really going to have that cut-through point where you're able to change the trajectory of your business growth.
I like to give the example, Kevin, of let's say I'm at a Greek wedding, right? And someone shouts out, "Hey, George." I'm probably not going to turn around. It's not going to get my attention because guess what? There's like 20 Georges in my family. If someone shouts, "Hey, George Koutanaris," there's a better chance I'll turn around, but there's actually quite a few George Koutanarises too. So you're not 100% going to get me. But if you say, "George Koutanaris, guy who posts on LinkedIn all the time and, is fascinated by B2B, I'm going to turn around, because that speaks directly to me. It's got my attention. And in the same way, when you are a newer brand and you don't have like the resources to go to head with the incumbent, with the big player that everyone feels really, safe in going ahead with, you need to make it very clear that we are built for you specifically. And that's why you should pay attention. And when you encounter this problem that I know that you're going to have, you're going to think of us before the rest of the other people when you do your shortlist. because we get you better than anyone else. So that's why this is so important.
That's it, George. We need to have that conversation directly with a specific niche, and that's why niching down is so important. But what is then your minimum viable market? How small should it be? How big should it be? Well, if we go back to Seth Godin, who speaks a lot on marketing in general, he said that it's the smallest market that can sustain your business and evangelize your solution. So right off the bat, you know that it's not just your TAM. It's not your total addressable market. It's the smallest market that can sustain your business and evangelize your solution. So that's pretty important as a definition to keep in mind. One of the greats in the space, but certainly helpful in the context of defining your own minimum viable market. And in our views, it's really the well-defined group of people with the same pain points who are actively looking for a solution that you can uniquely serve better than anyone else in the market. When you have hit that point where you're the best solution for this group of people, that's probably one of the best indicators that you've hit the right minimum viable market.
And Kevin, I think that's where you start to find that market that you can really sink your teeth into is where there is an existing market that uses maybe the incumbent, but their particular needs are not being satisfied by that player because they just have too many other needs to really, really satisfy. It might be a potential use case or something. And so finding a group of people who really need that particular use case, who aren't being served well by the incumbent, then that could be a market that you could chew off and you could say, hey, we are now building a product or solution just for you because we know how important this one use case is, even more important than the whole suite of things that incumbent competitor does too. So that's just an idea of how you can look into those pain points and start to slice off a part of the market for yourself.
It's certainly helpful that if they are in fact using the incumbent already, there's a budget there, there's a group of people that you can catalog, that you can have those conversations with to figure out exactly how to serve better. So certainly that's a great opportunity to try and find that group for yourself.
Okay, so how do you go about actually finding your minimum viable market? Well, it might be a little bit easier than you think. Let's go through the process, Kev. That all starts by what we call be ready, really starting to define who your dream customers are. And that really involves looking and revisiting your best customer analysis using the 80-20 rule. Now, this isn't a hard and fast rule, but the idea of the rule is that 20% of your customers are going to lead to 80% of the output. And that's not just looking at revenue, because if you focus on things like revenue alone, you might have a couple of big fish, a couple of big enterprise clients that are driving the bulk of the revenue, but hey, they might not be that profitable. That's the case with a lot of enterprise because they need a lot of resources to service them. So take into account whatever factors are really important to your business right now. That might be profitability. It might be potential for growth. It might be that they're in a segment that is going to be expanding and you know that there's going to be more people like them in the future. Take those factors into account, analyze your existing customer base and start to look and see, okay, like where are our best customers? What do they look like? We give people a scoring sheet, an 80-20 analysis template in the B2B incubator that people use and have found really, really handy to start to identify where their best customers are. But also, Kevin, I think we've spoken about this in a previous episode, who their worst customers are, what you call your anti-ICP. And you start to exclude companies that say, okay, companies that use us with this use case, they are less satisfied and they churn more because we don't do that as well as the competition. Or companies that use us that firmographically look like this aren't as great a fit because maybe our pricing is too high and their pain is not high enough to warrant and justify that pricing right now.
So as George mentioned, a lot of factors here can indicate or help you pen in who that roughly 20% is. Some other ones include potentially those with the highest lifetime value, maybe the lowest churn, the least effort to service and onboard, the fastest to close when they're onboarding, and the easiest to work with. All these things can be an indicator that these are in fact the customers that already are best fit for your product and offering as it is, or with very minimal work. And those are good indicators of a market that, again, comes back to that point around who you can service better than anybody else in the market and who is able to sustain your business. Obviously, you still have to look at the revenue numbers. It still has to be a majority portion of your revenue numbers so that you can actually focus in on this group without having a massive impact on your business revenue and bottom line. That's what we're trying to look for here. And once you have a rough idea of what that group looks like, start to look for commonalities to define this group better. On the firmographic side, you can look at things like industry, the size of the business, how much revenue they generate, and maybe even things like the tech stack that they use. And then on the demographic side, maybe looking at their buying committees and the people who use your product in terms of job titles, responsibilities, use cases, and levels of influence that they have in that buying committee. You'll know that you've really niched down enough when you start to see patterns in both areas. So both areas are starting to see similar patterns and you're starting to hone in on that same group as a result. Another thing to look at here is also the psychographics. Do they share same attitudes towards certain parts of the industry or work? Do they have the same pain sensitivity, we like to call it, in terms of like how much of a problem is certain things to them and how much are they motivated to solve those pain points? And what are those trigger points that help them get to the point where they really make a decision to solve particular problems in their work, in their processes?
Kevin, we worked with an organization that has a platform to help companies comply with ESG, and they found that there was a particular group of customers that really, really got the most out of their product compared to others, and that's those that actually needed to comply with something called the Modern Slavery Act. And that meant that their tool was actually specifically set up to help people comply with that, in addition to doing all the other ESG things that you need a tool to do. So they ended up being kind of their best customers, and an indicator as to whether or not someone was going to be a great customer was whether they had to comply with this legislative requirement to lodge what's called a Modern Slavery Act. And so they were able to very easily segment like the list of companies that needed to comply and do that and say, okay, this is a really clear use case as well. And they could segment it firmographically as well, even further, saying, hey, this works really well for companies that have their headquarters in Australia, have over $100 million in revenue, because they're the ones that are legally required to do this work. And this platform helped them do that work. So just another example as to how you can use this to really find those trigger points, to find those firmographics, demographics, psychographics to help you form what looks to be your best customers moving forward.
So then the next step in the process, listeners, is to use cataloging to test your niche. Now that you have a hypothesis, a pretty strong one, of course, around who your niche is, go and validate that by directly talking to them. We've spoken about customer interviews. This is where that comes in as well. Having that conversation in that cataloging process to confirm exactly how many there are, how much they're spending on services like yours, so then you can have a pretty accurate idea of how big this pool is and what is that revenue potential, so you can gauge accurately whether it is in fact big enough for you to sustain your business off, or if you need to readjust. And that's the final step in the process in setting your niche. Once you have that cataloging insight to support your hypothesis from the 80-20 analysis, you can then adjust that size. You can add or you can narrow it accordingly. At this point, you'll probably know pretty much whether your pool is big enough or not. If it's too small, you can explore adding maybe an adjacent niche to the niche that you have in mind so that your business can also serve that niche and it will be in fact big enough to sustain your business. And if it's too big, then obviously you have to narrow it down even further so that there's clearer patterns in that dream customer pool, that there's plenty of revenue in the pool still, so that you have the right balance between the size of the pool and whether you can service them the best in the market. As a general rule of thumb, we'd say probably around 100 to 1,000 companies is a good range for that first minimum viable market. But this should be a pool of customers that have an urgent pain that you can solve better than the competitors in market. Otherwise, more work probably needs to be done on your offering itself.
Evan, I just want to circle back to something you said earlier around making sure you go back and you catalog those people who are your best customers and also those that were your worst customers or churned ones too. That's something that we had always advocated for from a marketer's perspective. But also Adam Mandarovich, our good sales and CRO friend, said that he would always do from the sales side, because basically I think he was in a team where marketing just weren't getting these insights, and he would train his team to go back and call churned accounts or people where they lost the deal and say, hey, hope you don't mind me calling. Like, if you wouldn't mind helping me get my boss off my back, would just love to know kind of like why our conversation didn't progress any further. Open that up and then start to find out, who did they actually go with? Why did they go with them? And then all of a sudden you're getting all the information as to why they went with someone else over you or why they churned when they were with you. So you can start to spot what was wrong and what made them a bad fit. And what made them a bad fit might have also just been because they were actually a bad fit customer from the beginning. It might have been that your sales to customer success handoff was wrong. It might have been that marketing was targeting a different group of people. Sales was selling the dream and customer success were left with just a dumpster fire. But go back and do that exercise too, because you'll find out some really, really interesting things.
I think a final note, listeners, the example of our own business, the B2B Playbook podcast, we really narrowed down to demand gen marketers over a long period of time. Now we're expanding out that a little bit more as we start to be able to offer more services, be able to offer more courses and programs that speak to different niches better. But initially, we were talking to all B2B marketers, and then we narrowed that down to all B2B marketers in small teams because we realized the 5Bs framework is particularly powerful for this group. And then through conversations with this group and through doing our own 80/20 analysis and doing the cataloging through those conversations, we finally figured out that we should narrow it down all the way to demand gen marketers in small teams, all the way from all B2B marketers down to demand gen marketers in small B2B marketing teams. It's a long way down, but it's the way that we had to go to start to see that change in trajectory in our growth, to start to have that cut through with our content, and to talk to specific pain points with a group that is our minimum viable market.
Absolutely, Kev. Like, that's an example of how we've had to use both like our 80/20 analysis, our customer research to reposition the business over time and adapt to what is really our minimum viable audience. And I think what's really important to remember when you're communicating this, like with your executives as well, is just because you've positioned yourself one way doesn't mean you have to be positioned that way forever. It's literally just part of a go-to-market strategy. So you can position yourself to take a slice of a market, a segment of the market, and then once you are making good inroads into that, start to take money from that and reinvest into the next segment of the market. We know that sales cycles, can be long. We know that there's a marketing lag effect. So you want to be marketing to that next segment before you really need to start to bear some fruit from it as well. So it's literally just a go-to-market strategy to help you to get from A to B, and then you're going to reposition as the business evolves over time.
And this happens with some of the biggest brands in the world as well, listeners. Think the likes of Google and Meta, they all at one time or another marketed their ad services to small businesses. And they were very narrow about the small businesses they were after, whether that's mom and pop shops, whether that's physical stores or online stores or e-commerce stores, they all had to go at those different niches because they identified that at different times, those were the focus for their business. So again, as George said, it's just a go-to-market strategy. It doesn't mean you're ruling out everyone else in the market. It just means that you're focusing on a particular segment to help speed up the growth in that particular segment. And for small teams, that's really important to focus on one segment at a time to be able to grow over time. All right, listeners, that is how you niche down to your minimum viable market. Key takeaways for this episode: the minimum viable market is not your TAM, it's not your total addressable market. It's where you can have an unfair advantage because you can serve that niche better than anyone else in the market. And you need to balance that against the practical reality of having a big enough pool to sustain your business as well. That insight comes from doing your research in 80/20 analysis and cataloging properly to begin with. And finally, you can also refine that positioning over time as well. You can expand and narrow as your business needs.
Very good. Thank you, Kevin. Okay, listeners and viewers, as always, you can find links to everything we discussed in the show notes. We're so grateful that each week more and more marketers tune in every Monday. If we could ask one thing, it would be to please pass the show on to someone who you think you would get value from it. Also, check us out on YouTube. It's a huge help to us, and we really, really appreciate it. Thank you, Kevin. Thank you, listeners and viewers. Take care and catch you next week.
Thanks, George. Thank you, everyone. Take care and catch you all next week.